Hello, I'm Phil Middleton, Chairman of the Cunliffe Digital Monetary Institute, or DMI, and I am delighted to welcome you to this afternoon's conversation with John Cunliffe of the Bank of England to talk about digital currencies and other topics. I would say there are upwards of 1,000 people on this call, reflecting both the timely nature of the subject matter and indeed the eminence of the speaker. So good morning, good afternoon, good evening to you wherever you are in the world, and our audience is literally from all four corners of the world. I would ask you please to ensure that your video is off and that your microphone is on mute. This is a public meeting. It is on the record, and a transcript of Sir John's speech will be available on both the Bank of England and Cunliffe websites following this. So John is going to talk to us for 35-40 minutes or so, and then hopefully we will have time for some questions, which you can pose by writing in the chat box and sending them through to the team. So our guest this afternoon is Sir John Cunliffe, Deputy Governor of the Bank of England, involved in a multitude of tasks there, including being the Deputy Governor responsible for financial stability, having played a massive role in the government and the Bank of England's support to the UK economy during the pandemic, and has for the last 3 years been leading the Bank of England's work around central bank digital currency, digital payments in general. He's also joint chair of the Bank for International Settlements Working Group and Innovation Centres in that field, and has recently joined up with Her Majesty's Treasury to co-lead another working party on this subject. John is really one of the world's experts in this, and we are really grateful that he has taken the time to speak to us today, and looking forward to hearing his comments. So without further ado from me, welcome, John, and over to you.
Well, look, thank you very much, and thanks for the invitation. And just a warning to people, you may notice that I'm not doing this from the Bank of England. I'm doing it from home, as many of us are working from home at the moment, and I have a very loud doorbell. So if over the next half hour or so somebody rings it very loudly, I'm afraid I'll have to go up and answer it to prevent the session being disturbed. Hope you'll bear with me if that's happened. I mention it because it's happened a couple of times quite recently, but let's see if we can get through this without somebody coming to the door. So I want to talk today about whether we need public money, and I should make clear here that I'm not talking about public spending, but rather about the form of money itself. And by public money, I mean money issued by the state to its citizens for everyday use. And this may seem like a rather odd question to ask. In the UK, the Bank of England, a public institution, we've been issuing money to the public for over 300 years. Our banknotes, carrying the famous "I promise to pay the bearer" pledge, are carried in millions of wallets and purses and used millions of times a day by the public to make transactions. And these notes and coins are denominated in pound sterling, the currency of the UK. And it's the Bank of England, on behalf of the state, that is charged with ensuring the stable value of the currency by keeping inflation at its 2% target. Public money for general use in the UK is only available in the form of physical cash, but it's highly visible, trusted, and indeed it's probably the image that many people in this country have in their mind when they picture money. But the majority of the money held and used by people today in this country is not physical public money issued by the state, but digital or electronic private money issued by commercial banks. Around 95% of the funds that people hold that can be used to make transactions are now held as bank deposits rather than cash in everyday use. Only 23% of payments pre-pandemic were made using public money in the form of cash, down from close to 60% 10 years ago. This private money is not a claim on the state or backed with the resources of the state. It's not covered by that familiar Bank of England promise to pay the bearer. Now, it's not clear to me to what extent the general public are aware of this distinction between public and private money, or even that for most of the time they're using private money. I'm not aware of any surveys or research that addresses specifically this question. And I have over the years sometimes asked the question of those I've met, and I know that such an approach is statistically reprehensible, and one certainly shouldn't base policy on it. But for what it's worth, the answer suggests that people are generally unaware of any distinction between private and public money. And outside periods of crisis, the types of money they use, what and who stands behind it, is not really something they're particularly interested in. And the fact that, unlike in some periods of history and in some societies, we do not at present think much about these things, that people in the UK have a general confidence in the money they use, regardless of its form and issuer, is, I think, a very good thing. It's not an accident. It's due to the credibility of the institutional framework governing money that tethers private money to the public money issued by the state. And that framework's got a number of very important elements. An independent central bank ensures the stability of the value of the currency. Commercial banks that issue money are regulated to ensure they are robust. They hold accounts at the Bank of England, settle their transactions electronically between themselves in Bank of England public money, and they're able to borrow public money from the bank to meet liquidity shortfalls, including in times of stress. The deposit guarantee scheme gives holders of commercial bank money the protection of a backstop should the bank fail. And crucially, this tethering of private money to public money is, I think, also due to the fact that people have the right to exchange their private money, claims on banks, into public money, claims on the state, whenever they wish, as they do so every time they go to the ATM or pay cash into a bank account without any restriction or loss of value. We don't have to look all that far into the past to see episodes when this confidence in the money used in the UK, public or private, has been shaken. The monetary stability framework we now have is less than 25 years old and followed a prolonged period in which the value of all monies, public and private, denominated in sterling, was unstable. And the current regulatory framework for banks and the deposit guarantee scheme originate in an even more recent experience of the financial crisis only 10 years ago, when the government was forced to bail out the banking system at enormous cost to avoid millions of citizens losing the money that they held in the form of claims on commercial banks and the general loss of confidence in private money that would have followed. To be clear, I think the reforms we've made over the last 10 years have led to a much more robust and resilient commercial banking sector, and the experience of the last 12 months has demonstrated the resilience of the banking system to an extreme economic shock. But these not so distant episodes underline the threats to confidence in money or to particular forms of money, and that they are not just something in the history books. Money in the end is a social convention, and it can be very fragile and under stress. And it's not only a social convention, it's a very dynamic one. The forms it can take and the uses to which it can be put have varied materially through history and between societies. Change has often been driven by the interaction of technological innovation that has improved the functionality of money, for example, by making it more secure or making it more convenient to use. And we've been living through a period of such change for the last few decades. On the supply side, commercial bank digital money has become more available to the general public, cheaper and more widely used, especially for lower value transactions. And on the demand side, convenience, especially with regard to e-commerce, has fueled the public appetite for digital money. And as a result, the use of public money in the form of physical cash has been declining. These changes have been very marked in the UK, where they've mainly taken the form of the issuance of credit and debit payment cards to the general public, and the development of faster payment systems and of e-money, which is itself a derivative of commercial bank money. Digital forms of payment overtook cash in 2015, and they now make up 3/4 of all payments in the UK, with debit cards alone accounting for 42% of payments. And as the only digital money available to the public is private commercial bank money, This shift from physical cash to digital payment over recent decades has meant a shift from private to public money, from public to private money. The pandemic and consequent huge forced experiment in remote living, working and transacting has, at least temporarily, accelerated these trends. A recent Bank of England survey, for example, found that 70% of respondents were using less cash than prior to the pandemic. There has, for obvious reasons, been greater use of contactless payment and internet transactions. We don't, of course, know how persistent these changes will be when we emerge from the pandemic. I think, however, that it's a relatively safe bet that the experience of the last 12 months will lead to further acceleration of the move from physical to digital money, and with it, acceleration of that shift from private to public money. Over recent years, the technological innovations that have made digital private money cheaper and more convenient for both e-commerce and face-to-face transactions have actually been the result of technologies which, if not quite old hat, are certainly now quite familiar. But there are on the near horizon newer technologies such as tokenization and distributed ledger that may further transform the money we use. Stablecoins, a form of crypto asset, are probably the best known of these. Their proponents claim that they have the potential radically to reduce the costs of using digital money and to increase its functionality, the things it can do, embedding money much more deeply into the digital world in ways we can only now imagine. The proponents of these newer forms of money are typically not banks, but technology companies, including the so-called big tech internet platforms. Their business models are very different to banks. Many have no interest in providing credit, but rather seek to integrate new forms of money and payment into their other data-driven services. And this, of course, has attracted enormous attention, including from public authorities like the Bank of England. We're now wrestling with the thorny question of what regulatory framework should apply to non-bank issuers of private money. I don't propose to wrestle with that question today. We will shortly be publishing a discussion paper on the public policy implications of non-commercial bank digital money. Such developments would lead to a further shift away from cash and from public money. They may never happen, of course. However, having watched the digital transformation of other parts of the economy, one would not bet against the next wave of technology leading to further major transformation. We could now in payments be in a BlackBerry or mobile phone world about to see the introduction of the iPhone. I should make clear the Bank of England is committed to making physical cash banknotes available as long as there is demand for it, and is working with other authorities to support continued access to cash. And I should say, I don't think demand for cash will entirely disappear anytime very soon. Many people still rely on it for a number of reasons. But cash, and by extension, public money, is becoming an ever smaller fraction of the money we use in the UK and increasingly unusable in a digital world. We may not be there yet, but it looks probable in this country that if we want to retain public money capable of general use and available to all citizens, the state will need to issue public digital money that meets the needs of everyday modern life. And the question, and it's not just a question for central banks, is really, well, does it matter if the public can't access public money in a way they can use in their everyday lives? The current mix of public and private money in the UK is really the result of history rather than some wise, informed policy choice. And some might argue that generally available public money is becoming an anachronism. Given we have the credible public authority framework for private money that I described earlier, why should the state be involved in the issue of money to the public in competition with the private sector? The state does not directly provide electricity or water to the public in the UK anymore, so why should it provide money? These are important questions and they shouldn't be brushed aside. Any decision that the state should issue a new form of digital money to its citizens cannot rest simply on the fact that the role in society of public money is declining. It must rest on some assessment of the benefits of ensuring available and usable public money and of the costs and risks of letting it disappear. Such an assessment has not been done in the UK, and no decision has been taken yet to introduce a public digital money or to use its technical name, a central bank digital currency or CBDC. The introduction of a CBDC would be a very major public project, which would have material implications for the financial sector, for many parts of the economy, and for society more generally. The Bank of England, like many other central banks, has been exploring these issues in recent years. We published a discussion paper last year with an illustrative model of a general purpose public digital currency. And as I've said, we'll shortly publish another discussion paper on some of the public policy issues generated by new forms of non-bank digital money. In the budget last month, the Chancellor announced the establishment of a task force led by the Treasury and the Bank of England to ensure a strategic approach is adopted between the UK authorities as we collectively explore the issues posed by central bank digital currency. And I don't want to anticipate the outcome of this work, but on the basis of the work the bank has done so far, I can perhaps set out some preliminary views on where some of the benefits might lie and where, conversely, there might be risks in allowing publicly available state money to disappear. In doing so, I look to the future as well as to the present and to the possible entrance of non-bank issuers of private money, such as the big tech platforms. Given the speed of technological development in payments and of the changes we are seeing in the way we transact, any assessment that is not forward-looking is likely to be very soon overtaken by events. First and foremost are the financial stability implications of the absence of public money for use by the general population. Ensuring confidence in money as a means of payment and as a store of value is fundamental to financial stability. Does the presence of public money in the hands of citizens play any part in this? And the answer here, I think, lies in two related areas. First, the role that generally available public money plays in ensuring both the perception of the uniformity of money in the UK and the reality of the substitutability of all of the monies used in our economy. The fact that holders of any private money issued by a commercial bank have the right to convert it into public money, cash, on demand, is in my view one key element in the framework that guarantees to users that one form of money, say claims issued by Bank A, can be exchanged for claims on the state or claims on Bank B without any change in value. From the user's point of view, it is all just the same thing, money, pound sterling. The requirement on banks to be able to exchange on demand the money they issue through deposit accounts for Bank of England money also anchors the regulatory framework for banks. And the second area is the role that access to public money may play during times of stress when confidence in the issuers of private money comes under threat. Now, this is, I accept, a complex issue. On the one hand, during such episodes, easy access to safer public money may stimulate runs out of private money, amplifying the stress. On the other hand, the knowledge that under stress, depositors have the option to switch into state money may be important in preventing a more general confidence loss in money itself. Absent access to public money, the general public is effectively locked into private money. Deposit protection in such a world only enables depositors to exchange the claims on one bank for claims on another. In a systemic stress, when the robustness of the banking system as a whole is under threat, the perception that there is no route out of private money, that there is no access to a safe liquid asset backed by the state, could undermine confidence. And this perhaps hints at something more elusive and yet more fundamental about the role of public money in citizens' perception of money itself, that whatever its form or its issuer, confidence in the concept of money in society needs to be anchored by this perception of a liquid, safe asset that will always be accepted. Now, in previous centuries, gold has played that role, and its symbolism remains powerful to this day. In modern times in the UK, I think the state in the form of the Bank of England and its promise to pay, the bearer, provides that anchor. It's not at all certain whether the Bank of England could continue to provide that anchor, particularly in times of stress, if the public did not have access to the money we issue. In thinking about these possible roles of generally available public money, it's important to think beyond the status quo in which private money is issued only by tightly regulated commercial banks. As I set out earlier, there is now the very real prospect of non-banks, including the large technology platforms issuing new forms of digital money, such as stablecoins, for general purposes. These are likely to have greater functionality and lower transaction costs than the current commercial bank digital money offering, and could quickly attract large numbers of users. The role of generally available public money in anchoring both uniformity and confidence is likely to become more important in a world in which there is greater diversity in the issuers and in the forms of the money circulating in the economy. Now, one cannot, of course, prove that generally available public money plays the role in financial stability that I have sketched out above. I know of only one relatively small example of a modern economy in which the general public did not have access to state money, and I'm not aware of many in the historical record. It is certainly arguable that some combination of regulation and backstopping of private money in its current and future forms will be sufficient to provide the necessary anchors both in normal times and in stress. But there are clearly risks here to confidence in one of the fundamental underpinnings of the economy and of society. And unlike other fundamentals such as electricity and water, money is a social convention that depends on confidence. These risks will need to be very carefully evaluated in any assessment of whether we should be prepared to let generally available and usable public money wither away as the digital age progresses, or whether the state should issue its own digital currency. And as well as financial stability, there are other areas in which there may be risks in allowing publicly available state money to disappear and benefits from a CBDC. These concern the wider benefits from a well-functioning money and payments ecosystem for economic activity. This is an area in which the bank has a particular interest, but where responsibility is shared across a range of public authorities who I hope will be involved in the work of the task force. Specifically, I'm thinking about promoting competition, innovation, inclusion, and privacy. Ensuring competition in the provision of payment services is important for the wider economy. Today, businesses pay substantial fees in order to accept payments from their customers, whether directly to private companies or indirectly through the costs of sorting, transporting, and storing cash. Small businesses are particularly impacted in both cases. Customers don't see these fees, of course, but like other merchant costs, all else equal, they increase the prices that customers pay. Payment systems are, however, by definition, susceptible to network effects. Consumers and retailers prefer to use a payment method when it is already widely used, and so customers gravitate towards large payment platforms and systems. This dynamic makes it very difficult for new payment firms to enter the market, which can in turn insulate incumbents from competitive pressure. Looking forward, the challenges of delivering competitive outcomes is likely to grow more complex. As the payments business becomes increasingly integrated into the digital economy, the use of data has the potential to deepen the network effects in payments. For example, if big tech platforms, which have a very different data-driven business model to banks, if they are better able to extract value from user data, they may be more able to more heavily cross-subsidize their payments businesses. Interoperability is key for fostering competition in payment systems. And by interoperability, I mean the ability of consumers to move funds across systems or between providers with little friction and at no substantial cost. New money and payment innovators with powerful data advantages could have very strong commercial incentives to set themselves up as so-called walled gardens, systems that are not interoperable with others and therefore lock in consumers. And competition is important also because it acts as a spur to innovation. As I observed earlier, we may still be in the BlackBerry mobile phone phase of innovation in payments. The new technology and growth of digital payments is increasingly allowing for specialization and innovation that is giving new options to consumers over how they pay and how money works. Ensuring competition will be a key to the conditions in which such innovation can flourish. Now, competition and cost control can be ensured by regulation, by access to infrastructure, and by common standards. And we do all of that in the UK. Payment card fees, for example, are capped, and the payment system regulator acts as the economic regulator of the main UK payment systems. Other regulation prescribes common standards for non-banks to access bank-based deposit account information. And the Bank of England has widened, and we're considering further widening, access to our central payments infrastructure to include non-bank payment firms. However, public digital money could also have an important role in this respect. The option of paying in cash has in the past served to anchor the cost of face-to-face transactions. Looking ahead, as payment options proliferate, the option of using digital public money as an alternative to private money could play an important role in anchoring cost. And equally important, digital public money and the infrastructure necessary to support it would help to ensure the necessary interoperability and common standards between all major payment systems in the future economy. The extent to which digital public money in the form of a central bank digital currency could play these roles would depend on its design, most particularly on its interaction with the private sector. In the discussion paper last year, the Bank of England set out as an example a platform model of a central bank digital currency. This illustrated the role private firms might play in delivering interoperability, innovation, and competitive outcomes as part of a future payments landscape. In the model, digital public money would operate alongside private money as cash does now. The central infrastructure in the model would be operated by the Bank of England, but all customer-facing services would be provided by the private sector, banks and non-banks alike, who would be able to plug into the Bank of England infrastructure and integrate digital public money into the services they offered. Now, there are also, as I said, some wider social questions about the type of money we use, which I describe as falling into the category of values, and I'll briefly highlight a few of these. The first is inclusion. It's important for social as well as economic reasons that all have access to money in the form they need to make transactions. Physical cash provides a backstop. It requires very little of users, neither identification nor ownership of a smartphone, nor any particular understanding of technology, but it is increasingly a backstop rather than a fully functioning alternative. Today, there are 1.2 million unbanked people in the UK who by and large rely on cash and cannot access digital payments or can access them only at disproportionate cost. The experience of the last 12 months has highlighted the risks and costs of digital exclusion generally. As the economy becomes increasingly digitized, the social consequences of exclusion from digital money will become more severe. This is not simply due to the growing importance of internet transactions. We're already seeing a small but growing number of examples in which cash is simply not accepted for face-to-face transactions. As we've seen over many years with the banking system, future money and payments providers may not have the commercial incentives to provide usable services for the unbanked and other parts of the population. Digital public money, appropriately designed, may therefore have an important role to play in ensuring inclusion. And a second area in this values category is privacy. And this is a complex area. There's clearly a trade-off between the need for effective law enforcement to combat illicit activities on the one hand and citizens' right to privacy on the other hand. This is not an issue for the Bank of England, but I can say the balance will need to be struck in the same place for digital private and public money alike. It may, however, be considerably easier to implement for digital public money. And there is an important other privacy concern: the use of data on individuals' transactions for commercial rather than law enforcement purposes. This is and will, I'm sure, continue to be covered by regulation. But as most of us have probably experienced when being asked to give permission to use our data, there is often not an effective alternative option which offers greater privacy available to us for the service we need. Given the network effects around money and payments, it is not wholly clear that absent public digital money, such an alternative would exist. And finally, and perhaps most simply, should citizens have the right to hold and to use the safest form of money, public money, both in their usual everyday lives and in times of uncertainty? It's perhaps no coincidence that demand for Bank of England money cash has actually gone up during the current pandemic, even as the use of it in daily transactions has gone down. When seeking to deliver public goods, such as inclusion and privacy, and also for competition and innovation, one might look to regulation to achieve desired public policy objectives. And indeed, the same might be true for the public policy objective of financial stability. But regulation alone is not always the silver bullet for complex, multidimensional public policy objectives. It can be expensive, slow to react, and difficult to police. It can also create barriers to competition. It may be that a consistent regulatory framework across a range of policy areas could mean that it wouldn't really matter very much if the population at large lost access to usable public money. But it might also be that a well-designed and effective public money, in combination with regulation where necessary, would provide a more efficient and, in the end, a more robust answer. These issues and their implications for the design of any digital public money in the UK will be at the centre of the work of the Treasury Bank of England Task Force. We will explore also in the broader engagement group with a range of stakeholders that has been established. There are other important questions that I haven't covered today about the public policy implications of any shift away from commercial bank money into new forms of non-bank digital money, whether public, like CBDC, or private, like stablecoins. As I've said, those will be explored in a Bank of England discussion paper we hope to release in the coming months. My message today, however, is that even without the new technology-enabled forms of money that appear to be on the near horizon, we are seeing accelerating change in the way we live and the way we transact that will greatly reduce and perhaps eventually eliminate the role that public money plays in the economy today. New technologies and the entrance of new players are likely to reinforce these trends. We should not let this happen by accident. Whatever the outcome, it should be based on a careful and a thorough assessment of the implications of such a change and of the alternatives that may be available to us. Thank you.
Thank you very much indeed, John. That was a masterful tour de force and wander around a lot of the major public policy issues, and already a whole host of questions coming in. Let's start with, if we accept that there is going to be a public appetite for digital money, for a whole range of reasons. Untitled Research has indicated that your suspicion that the public doesn't really understand the difference between M1 and M0 or public money or private money is absolutely well-founded, and it comes out of our quantitative research and indeed out of subjective research I've done as well. And our research has also showed very strongly that the whole issue of privacy is very much uppermost in consumers' minds, which I personally find quite strange, because by and large, we're happy to hand over our data to LinkedIn or Facebook, and our commercial banks hold mountains of the stuff, even though they don't tend to use it particularly well. But let us assume, for the sake of argument, that the central bank decides to introduce a digital currency. How are you going to take citizens along with you? Is this a matter for Parliament? Is it the central bank? How are we going to explain to my mum that we're not abolishing the Queen, we're just giving her a different way in which to buy my birthday card?
Okay, so look, I think maybe I'll turn to the privacy question. There are a number of different issues there. So the first point to make is that where we, if I can use the term, put the cursor on the right to privacy and, for example, access by law enforcement agencies, is not something the Bank of England will or should determine. Okay, it's something Parliament should determine in the way that it determines access to data for telecommunications or for other purposes. That's one of the reasons why this task force, which the Chancellor set up, is so important, because we need to take this subject out of the realm of just central banks and broaden it to include these social and political questions. And I think Parliament should be very interested in that. I don't know where the balance will be. I think there are good arguments that cash, in its current form, a bearer instrument, an anonymous bearer instrument, carries a range of social costs in terms of illicit activity, tax avoidance, but on the other hand, citizens value its privacy. It's a great book by Ken Rogoff on the costs of cash, and that balance will be set somewhere. And what I tried to say is, if as digital private money develops further, stable coins, bank accounts, etc., And if there is a CBDC, my guess is the balance will be the same for both. You won't get, for law enforcement purposes, kind of more access to public than for private. Where I think there is another thing, though, which might interest your grandmother, is whether she wants her data on transactions to be exploited for commercial purposes. And we're all familiar with that. And again, there is regulation. But I think there is a possibility that a digital public currency, because it doesn't need to be commercialized in that sense, could offer more, depending how it's designed, could offer more privacy. But of course, it's not just the digital currency itself, it's the accounts or the wallets in which it's held and the rules that will apply to the whole ecosystem. But I think the public will need to get comfortable with these concepts, but that will need to happen whether we issue a CBDC or not. It's happening already. So the more the public wants to transact and live and kind of integrate in their transactions into a digital world, the more that question arises.
Although the public finds it difficult to make the distinction between public and private money, and will probably continue to do so. Do you think that, let's say for the sake of argument, we introduce a digital pound sterling, would you want to replicate precisely the functionality of cash, i.e. anonymous bearer instrument, or do you see it more as an opportunity to, and you used the whole BlackBerry iPhone examples in your speech, to move to what I might call next generation money, whether it's smart money, programmable money, or whatever. But so we take a quantum leap in the way in which money circulates and is used in the United Kingdom?
Yeah, or it could be both. Look, first thing is that those are, I mean, that's precisely the sort of issue that the task force needs to examine. We, along with a number of other central banks, published a report last year on design choices, fundamental principles, design choices for a central bank digital currency, which has these trade-offs between certain forms of functionality and anonymity and complexity. I think go back to what I just said, whether we have a digital public money that is equivalent to a bearer instrument will depend on two things. One, it will depend on where society, parliament decides to put the cursor, as I can put it that way. And there is an argument to say, well, actually, we don't want a fully anonymous bearer instrument in society anymore. Other people will argue that anonymity is a basic right. So that's a political choice. There'll also be a technological choice. And I think at the moment, it looks as if it's going to be dauntingly difficult with the technology we see to design a bearer instrument that is safe and secure and not, well, you can't counterfeitable, actually just duplicate in a digital world could have much larger consequences than counterfeiting in a paper world. So there'll be a technological side to that question. And the model we set out in that discussion paper was account or wallet based, not a bearer instrument. But those are, I mean, they're within those design choices, there are political and basically values choices that will have to be made.
And of course, it fits into the much wider digital society questions of digital identity in its broader sense. And we're just starting to have the debate again in the United Kingdom about identity cards and so on and so forth. So that is going to be part and parcel of it. Can we move to another, putting one of your other hats on, which is financial stability? The number of questions coming up, and there is a strong argument from people saying that a CBDC is inherently disruptive to the existing financial system in that it removes payment income from banks and so harms their profitability. But even more worryingly for policymakers, it might tend to shrink the availability of credit in the economy, because Banks create money and create credit, and if deposits are moving into the central bank, then the amount of money ipso facto in the economy is going to shrink, therefore lower economic growth. Where do you see that?
Okay, so I mentioned that we will be issuing a discussion paper in coming months on
Yes.
Public policy implications. I called it of non-bank digital money because many of those concerns apply to stablecoin as much as they apply to a central bank digital currency. It's about an alternative to commercial banks for a digital offering, which would lead to the flow of transactions out of the banking system. And in that paper, we'll try and set out some of the possible implications and to model some of the impacts they may have, both on banks' business models, but also on the cost and availability of credit, and some of the implications that might have at time of stress, which is different to business as usual, whether the availability of other forms of money just encourages bank runs. I'll say a couple of things, though, without wanting to preempt the paper. One is the demand for a CBDC or a stablecoin is effectively unknowable. I mean, it doesn't exist at the moment. And if you look at the iPhone, I don't think many people, when it was launched, thought the demand for what it could offer would be anything like what it was. But we have tried, and we try with the available data, to model just how large a deposit flow out of commercial bank money might be, and what the implications might be for banks. And to my mind, it suggests that whatever you do in this area, one needs to proceed quite carefully to make sure that you avoid unintended effects. That said, the Bank of England doesn't have the responsibility or a brief to preserve the current model of banking. We have a responsibility to preserve financial stability, and the current role of banks and financial stability are not the same thing. If there are to be changes, if the way we want to make payments, and look, the way we make payments and what commercial banks do has changed hugely in the last 50 years. And if there are to be future technology-driven changes, then I think the financial stability concern is to ensure that the process of change is managed, and that we underpin or that we have ways of countering, if you like, financial stability risks. And the paper will explore how that might happen. But I think I'll leave it there, I think, rather than anticipate it.
Well, we'll look forward to the paper and invite you now publicly to come back and share all those conclusions and discuss them with us. And indeed, the Bank of England has been very innovative of late in allowing non-banks access to certain elements of its balance sheet, and in thinking about how that universe expands and develops, which leads me on to a thought. We've focused an awful lot about public retail money. If one thinks in the wholesale arena, does the opportunity for a jurisdiction to issue digital currency in a wholesale, let's say stablecoin or state-backed digital currency, offer jurisdictions new opportunities for financial markets? Clearly thinking about, but not restricting to the city post-Brexit?
So I think within some of these technologies, it's huge opportunity for wholesale sector and retail, actually, to reduce the cost of payments cross-border, whether they're very large payments for financial markets, which tend to be efficient, certainly relative to the cost of making retail transactions across border. And you mentioned at the beginning that I chair the Bank of International Settlements Committee on payments, and we're looking at a roadmap under the G20 with other authorities to make cross-border payments of all sorts much more effective and efficient. So there's huge opportunity there. There are quite a few proposals now in the private sector for ways of doing that, and for dealing with risk using wholesale stablecoins, but also using a range of other technologies. I think there's an enormous, what's the best way to put it? If we can coordinate to make sure that we approach these things in the same way, and where necessary have common standards, there's an enormous efficiency gain to be got from this area. The one point I'd make, and this is something which is also the responsibility of international organizations like the IMF and the like, is that if you make it much easier to transfer money between currencies and jurisdictions, you also create public policy issues, so-called dollarization. We have them at the moment. People run out of private money or out of state money when they lose confidence in it and they seek something else. The question is whether the sorts of things we're talking about, either wholesale or retail, make that easier, and what impact that has on the international financial system. I know the IMF is doing a lot of work on that. And I think in any work we do nationally on a CBDC or on cross-border stablecoins, we need to build that aspect in as well.
And indeed, one of the conclusions or requests from our recent international symposium was that international regulatory standardization, coordinated supervision, and coordinated technical standards would be a very, very good thing. However, there was then massive disagreement about who should actually do it and where it should be done.
Well, I'd say one thing, as far as stablecoins are concerned, and sort of the private side of this, the CPMI committee in Basel, together with IOSCO, are working to see how these new forms fit in to the basically to the international standards, the principles for financial market infrastructure. And of course, the PFMI were written 10 years ago, before we had these developments. But the question is, what's the regulatory framework that should apply to these things, internationally agreed? And basically, if a payment system is not just a payment system, but is also creating the settlement asset that is kind of transmitted through the payment system, which is what stablecoin is, then how do you ensure that users have the same security and robustness that they have using commercial bank money or central bank money? So there is work going on that regulatory framework.
And just a final question. Let's assume somebody else beats the Bank of England to the draw and that there is a digital euro appears. What's the approach of the United Kingdom then to that currency, that digital currency? Would we open our borders, or how would we deal with it?
Well, just to answer a question you didn't ask, but it's maybe worth commenting on. It's not a race. And that group I talked about includes the central banks, includes the Fed, includes the ECB, G7 central banks, and Bank of Canada and the Swiss National Bank. And look, a CBDC may take different forms in different jurisdictions because you want to achieve different things. We could have different rules on privacy, for example. You could have different rules on inclusion. We talked about some of the issues around how to design this for the public. So the outcomes, the types of money we have, it's already quite different in different societies and the rules that govern it. And that difference may persist. I think the question about whether we would want another currency to circulate in the UK as the UK currency, it's kind of dollarization question. That's a monetary sovereignty question. My own view is people will transact in the UK in pound sterling, whether it's private money denominated in pound sterling or public money denominated in pound sterling, as long as they have confidence in the institutions. And that regulatory, well, it's more than regulatory, that framework around the currency that ensures the stability of its value, and the framework around private money that anchors it to public money and the value of public money. And as long as people are confident of that, they'll continue to transact in the national currency. You see around the world, when people lose confidence in private money, they go to public. And if they lose confidence in public, they go to some other public, normally, or some of them go to gold. So it's really in our own hands, I think, what money is used. If we continue to provide credible, safe, reliable money in the UK, then I don't see euroization or dollarization as an issue.
Thank you. And indeed, there are some countries where savers are now holding their savings in Bitcoin or cryptos or other assets because they don't trust public money. So, and I tend to agree very much with you that that issuing public money is an expression of sovereignty. And I think both me, my mum, and my grandma won't fully trust money unless it's got a picture, physical or otherwise, of Her Majesty the Queen on it. Anyway, thank you very, very much indeed for giving us such a wonderful tour, and from some very interesting perspectives as well. Thank you for asking some impertinent questions for me. I'm going to give you a break for a cup of tea, because I know you're joining us for a private invitation only session for Digital Monetary Institute members shortly. So may, on behalf of everybody, may I thank you very, very much indeed for that address. As I say, the Sir John's transcript of his remarks available on the Bank of England website or the OMFIF website. You can trust either of them. Thank you very much indeed for being with us. And with that, thank you to everybody around the world. I hope you found this useful, and I'm now closing the public session. Thank you.
Okay, thanks a lot. Thank you.